Hi, I'm Josh Young with Bison Interests, and we're doing a short macro update on the oil markets given volatility and a lot of uncertainty in the market, and what we see as some confusion around some basic points that could lead to a multi-year continued oil bull market. First, a short disclaimer. Anything that we say here is not a solicitation or an offering of securities, and there are no investment recommendations on this. So what we're going to do here is talk a little bit about Bison, who we are, a little bit about what's going on in the current market, and a little bit about the supply dynamic as well as the demand dynamic in the oil market. So a bit about me. I have been investing in the oil and gas public equity space professionally for the last 15 years or so. And I was also chairman of the board of a publicly traded oil and gas company that materially outperformed its peers while selling $80 million of assets and then selling the whole company in a multi-hundred-million-dollar transaction. A little bit about Bison. So I've talked about a few stocks. I'm not supposed to show the fund's performance, but I think it's probably possible to understand how we've done by seeing some of the stocks that I've talked about publicly over the last 18 months or so and how they've done versus the overall oil and gas index XOP. And you can see some of the companies that I've talked about have really materially outperformed, such as Sandwich, which is up almost 600% since I first talked about it. And the most recent one, Journey, is up almost 200% in less than, I think, what is it, 2.5 months, something like that. So none of these are recommendations, and I do still own these stocks. So from an oil market perspective, part of the question is why now? Obviously, oil prices are up from their low, and there's a lot of uncertainty in the market. And so one way to tell what's going on is to see what's worked in the recent past. And what we noticed was that when COVID cases peaked and then started to fall, and COVID deaths peaked and started to fall over the last several COVID waves, there were great buying opportunities in oil and gas stocks as well as in the oil price. And so what we're seeing now is that oil prices were rising into the peak for Omicron, and we see that there is kind of this potential for oil to decouple as COVID hopefully goes fully in the rearview mirror, and that this is a good indicator as a starting point that now is a promising time to get exposure to the oil and gas space. The oil market structure is bullish. So we'd done this analysis and found a good chart from a macro newsletter and showed their chart. And it's pretty simple. When the oil market's in backwardation, it looks like the futures market is saying that oil is going to be cheaper in the future, but really that has to do with kind of the term structure and how much it costs to essentially pre-buy oil that you get delivered multiple years out in some cases. And so really what it tells you is that when there's steep backwardation like we're seeing now, with the forward price for oil lower in the future than today, it's most likely that oil prices will rise and not fall based on the number of times where the market structure has been similar and what's happened to the price in a similar market structure. So another way to see what's going on, as well as to calibrate reliable sources, is to see what those sources show for demand estimates and inventory estimates and how those change over time. And so this is a set of inventory estimates from the EIA, which is a US government agency. And this shows pretty simply that oil is in more demand than the EIA is saying. This is also true when you look at IEA, which is a kind of another government agency. And when you see other sorts of groups that give estimates like this, too often they're underestimating demand and they overestimate the amount of oil in inventory. And as you can see, there's a pretty powerful trend for oil inventories to decline and for this agency and others to overestimate to overestimate inventories, underestimate demand, and really, I think it really calls into question a number of the longer term forecasts. If you're going to get 1 year this wrong and have to reset it this many times, what's that say about EIA's 2 years out, 5 years out, 30 years out sort of estimates? And we think this is supportive of a much stronger market than people understand, and is a reason why we could see oil prices rise for some time going forward. So in addition to inventories being depleted faster than consensus is expecting, there is a bigger issue, I guess not necessarily bigger than inventories, but there's a overriding industry structural issue, which is that there's been grossly insufficient spending by the industry to discover and replace reserves that are being produced. And as you can see from this chart, spending is down essentially 50% from its high a number of years ago at the peak of the last cycle. And that tells you that there's just not enough oil that's being discovered and not enough activity towards that discovery and development to be able to sustain current production levels, which means that if we're in a declining inventory environment and we're underspending, that the market could actually get a lot tighter before it starts to turn around. This is another way to show the same thing. This is specifically for US shale producers. And what we're showing here, and this is a chart from Credit Suisse, what they're showing is that producers are spending a historically low percentage of their cash flow this year, as well as spent a very low percentage of their cash flow last year. As they spend a low percentage of their cash flow, they end up with less production, and that is supportive for the oil price, and it is likely to draw oil inventories further. And we're still kind of in this downturn portion of the cycle, even with prices where they are. And this, along with the prior slide, and this sort of trend of much lower spending could result in much higher prices over a multi-year period. So in addition to spending a lot less, there's also not enough people who have experience and are qualified to do various oil field tasks. And this was already a problem even before COVID, and it's becoming a much more serious problem now. And this is going to be seen, and we're already starting to see early indications of it, of lower rig productivity and requiring more spending in order to get the same oil as would have come with more experienced labor. And so you really need experienced, talented people in the oil and gas industry. And with fewer such people, it presents a problem in terms of delivering enough oil to meet rising demand. So this is a chart showing essentially how demand has tracked over a multi-year period, and there's been this growth at 1% or more in the long-term demand for oil. I think this is over a multi-decade period that's been the case. And as you can see, demand has been rising much more rapidly than supply, and we're actually seeing a bigger disconnect now than we saw last year. And again, this is leading to big inventory draws, and this is going to be a problem for the oil market because ultimately supply and demand have to clear, and when demand is higher than supply, what that does is it drags price higher, and we're seeing prices higher and demand continuing to grow more than supply. So again, this puts us pretty early in an oil and gas cycle where we're still materially undersupplied and where the trajectory is actually to be even more undersupplied. Another way of seeing this is in terms of the likely stickiness of demand is to see how much oil we're using here in the US versus in countries like China and in various poor countries around the world. And what we see is that we use way more. A friend likes to talk about how in some poor countries, they use less on average than an American uses of energy just to power their refrigerator. So there's really a big step up in quality of life in emerging and frontier markets. And this is great in terms of quality of life for humans, but it's also challenging to supply all the energy needed for that. And it's one reason why we're seeing oil demand rise so fast. So we've talked about oil inventories falling, and I think this chart is particularly evocative. It shows days demand, so it shows the amount of inventory divided by the amount that's consumed per day. And what you see when you do that calculation is that inventory remaining in OECD countries, but really globally, is falling, and it's at multi-decade lows. And you can see that actually inflation-adjusted oil prices are still relatively low versus how far inventories have fallen. And this shows the potential for oil prices to rise dramatically from here. And again, this is acknowledging that oil prices have risen, but we see a lot more upside for oil price. And we see that driven at least partially by these very, very low oil inventory numbers. So another way to see that is to look at what oil inventories looked like on an absolute basis in a time frame where oil was on average $100 or greater. And so what we see is that oil has drawn out of inventory sufficiently to move well beyond the last few years of the low price environment. And we've now drawn into the level where we were in the 2010 to 2014 area, where oil prices were on average around $100 a barrel. And on an inflation adjusted basis, that implies something closer to $120 a barrel today. And you can see that the the inventory trajectory is still negative. And so as inventories fall further, there's the potential for oil prices to rise even more. This also shows on the bottom chart what's happened in prior periods where there's been strategic petroleum reserve releases. And it looks like more often than not, when there's an SPR release, oil prices actually go up, not down. So I think the oil market can get easily spooked by the announcement of an SPR release. But now that we're seeing another SPR release announcement recently, this is actually potentially promising and could indicate oil prices may go up, not down. And part of the reason for that is that, especially at current strategic petroleum reserve levels, there's an argument that it's just being counted towards global inventories. And so as that gets released, it reduces the essentially emergency amount of oil available, and that increases the odds of an extreme price movement higher if the supply was disrupted. And so it tends to bias, and it seems likely to bias things even more as the SPR gets smaller. It may bias prices higher with the potential for kind of extreme right tail events. So this chart is pretty interesting and really worth considering, and is along the lines of what we were showing earlier, where the trend recently has been for limited spending and limited activity versus how much cash flow the producers are generating, as well as versus history. And there are some arguments that drilling rigs are a little more efficient now than they were a few years ago. And they're certainly more efficient than they were in 2014, when there were 2 or 3 times as many rigs active as there are right now. However, as we have labor issues, as more rigs get online, as less promising locations are drilled, as each of those come into play, rig productivity is falling. And so what we're seeing is the potential for even higher prices needed in order to drag the rig count higher to be able to adequately supply the market. So we're still way too low, and we see a lot of potential upside to the rig count. And in order to get that rig count higher, it looks like the market is demanding higher and higher prices in order to accomplish that. So there's another phenomenon that's going on that's really partially driven by this underinvestment by oil and gas companies, and partially is indicative of there being a problem that will either need to be resolved through higher spend or through less production. And this problem is that there are drilled uncompleted wells that had been declining. They're essentially working capital for oil companies, and they're down almost 50% from their recent highs a couple years ago. And that's an issue, again, because you need a well that's drilled to be able to complete it and bring it on production. And so if you run out of wells that are already drilled, then you can't complete wells that haven't been drilled yet. So there is kind of a math problem here, and then many of the remaining drilled uncompleted wells had other issues and may never get completed. And so this is really a working capital issue, and it's a little bit technical and specific, but it's also worth watching because this could actually drag production a lot lower or drag capital spend and that rig count that we showed in the last chart a lot higher. This is another way to show the same thing. Essentially, we're seeing the frac spread count not growing as much, and we're seeing the rig count growing. And again, what this means is that as oil companies start spending more, it doesn't necessarily mean that they're going to grow their production. A lot of it may actually have to go to just keeping their drilled uncompleted well count flat. And currently that count is continuing to fall. And so there's more and more money and more rigs that are necessary just to keep that to keep that drilled uncompleted well number flat. So this chart shows there's generally been this link, but we're still missing, it looks like, around 100 rigs, maybe a little more, in order to keep that DUC count flat. So as we think about the oil market and think about kind of instantaneous responses people have to oil prices rising and to a market being tight, one of them is, okay, we're going to release some oil from a strategic petroleum reserve. Another is, oh, high prices lead to way more drilling, and way more drilling leads to way more production. As we've shown that those are not the issues that are commonly perceived, it's worth addressing OPEC, which is conceived as kind of the supplier of last resort. And what we've seen is that OPEC producers, while they've been increasing their production quotas every month for the last year or so, they're actually missing those quota numbers every month. And it's actually, you can see this by country, that there are some countries that have been missing, and you can also see it by month. And what this tells us is that there probably isn't as much spare capacity as OPEC Plus is claiming. And what that means is that the market is tighter than we think, and there may be fewer options for near-term oil production in order to meet growing demand. And then again, this is showing kind of specifically where this miss is happening. And there's a set of smaller OPEC Plus producers that are really struggling. But it's also worth looking at this closely, because what you notice is while OPEC quotas are not being met, you're not seeing extra production from Saudi Arabia, Russia, UAE, etc. You're not seeing that extra production to make up for misses from other OPEC Plus members. And so that's indicative of potential issues at these larger countries. And there is the possibility that as these quotas come back up, that we start seeing bigger misses from Saudi Arabia and from Russia as well. So there's one other thing that's happening that is really worth addressing here, which is this energy crisis in Europe. And now, as we've seen tensions build and spill over into actual war between Russia and Ukraine, in the lead up to that, there have been significantly reduced exports from Russia of natural gas to Europe. And there's been an energy shortage and crisis in Europe and Asia, partly as a result of that, and partly just there was too much reliance on alternative energy, and nuclear power plants and others were shut down. And so there's really been this problem, a combination for that market of supply being insufficient and demand being too high. This has dragged European and Asian natural gas prices way higher than they've been historically, 5x or more higher than where they were even a year ago. And so what that's done is it's increased demand for oil and oil products as a substitute for natural gas. So for power generation, for home heating, etc. And so this has been an extra driver of demand. And the bearish argument has been, oh, okay, well, it's going to go away after the winter. But the reality is that European natural gas prices, and it looks like Asian as well, going forward are priced on their forward curve a lot higher than they've been historically. And the longer that happens and the higher they are, the more oil is going to be used on a more permanent basis to substitute for natural gas. And what's happening is we're showing this over the last year. You can see oil getting dragged up to some extent by this substitution for European natural gas. And obviously it's a very complicated subject, but it's also worth watching and noticing because this may actually be a sustainable incremental demand driver for oil that could, again, drive oil prices much higher than people expect. And this effect was expected to already be subsiding, and it's not. And there was a risk that oil actually gets continued to be consumed for uses that natural gas had been used for into potentially the indefinite future. So when you think about the oil market, what we've described up till this point is just purely the supply and demand dynamic for oil, the commodity. So when we think about what happens to resolve this issue of insufficient supply relative to growing demand, one way to unlock this would be for producers to spend a lot more money. And the challenge is that producers are valued very low relative to historical percentages of the indexes, as well as relative to their overall valuations. And so we think that you need to see much higher valuations for oil and gas producers in order to see a lot more activity and sufficient production for the market to clear and oil prices to stop rising. And so we're obviously very far from that. And even this 4% number for energy in the S&P 500 may actually be overstating the current composition, because a number of the producers that are included in there, some of them actually are not producing oil, they're producing other forms of energy that maybe should not be included for this calculation. And then also this shows ARC, which is interesting because ARC and unprofitable tech stocks are following the path of the .com stocks from the 90s. And we show this overlaid on this chart on the bottom right. And what this tells us is that there is this revaluation process happening, and what we need to happen is starting to happen, but that we're still really far from this. So the mechanism is working, and energy stocks are up a little from their lows of 2% of the S&P, and that there is this mechanism that's working. We just need it to work faster, and we need it to work a lot more. And really, energy stocks should be at least 10%, and maybe they'll get closer to their all-time highs of 20 to 25% like we saw in the late 70s and early 80s. This is another way to show the same thing. This is a chart from TD Securities, and this shows how cheap oil and gas stocks are on a cash flow basis versus how they were priced historically. And this is noteworthy because even in the middle of a downturn, the producer stocks in some cases were trading closer to 10 times EBITDA, and now they're trading closer to 4 times. And one other thing that's worth showing, and maybe we'll show a slide in a future update of the market, there's really big dispersion in valuations across these producers. And for every producer that trades at, let's say, 6 times EBITDA, there's one that's trading at 2 times EBITDA to get to this sort of 4 times or so average. So this is very interesting to us. We obviously prefer to buy producers that are on the lower end of that valuation range. And this shows one of the challenges that producers are having, which is if you're at 4 times EBITDA and you're not really getting rewarded for your cash flow, you might be better off just taking that cash flow and repurchasing shares or paying a dividend than you are in trying to grow in order to just achieve a 4 times multiple. So with that, I'm going to wrap it up. We appreciate your time today, and always happy to get feedback and answer questions. And we hope to hear from you either by email or on our social media. Thank you very much.